Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets and the economy. Let's get started. April of 2020 marks an important milestone. March 31st of last year, we published a strategic insights that we entitled Modern Monetary Theory to the Rescue. And in that strategy publication, we suggested that despite the undeniable human pain and economic pain that the COVID pandemic was likely to inflict, we felt that the money printing binge by the Federal Reserve was likely to unleash an extraordinarily powerful rally in equity and housing markets. 1 year later, the S&P 500 is up 53%. Home prices, depending upon the index you select, up about 15%. The key question for investors now is, what's next? What should we expect for the balance of 2021? And in answering that question, when can we expect these good times to end? What is going to be the catalyst that stops this powerful bull market? Now, we want to take that question and answer it in two ways. First, we want to be clear on what we do not believe will be the causes that bring this powerful bull market to an end. And then second, we want to really focus investor attention like a laser on the one thing that we believe brings almost every bull market to a crashing conclusion, and that is Federal Reserve policy. So first, let's address the things that don't typically bring a bull market to a close. Despite all the rumors and all the ink that's being spilled right now, fretting and worrying about different aspects of the market, bull markets do not end because of the calendar. Oh, we've struck our 1 year anniversary. There is no calendar for a bull market. There is no necessary clock that brings them to an end after a certain period of time, or means that they can't possibly end because they're only 1 year old. Nope. The calendar has absolutely nothing to do with what is likely to happen to investors. What about valuation? We've written extensively, and lots of people are jumping on the bandwagon about how extremely expensive this market is compared to historical averages. And that is absolutely positively the case. However, our analysis of historical market returns suggests that valuation is critically important in assessing what you are likely to receive from your equity investments over the next 5, 7, 10 years. But over the next 1 year, then valuation doesn't really tell you a whole lot, because cheap markets can keep getting cheaper and expensive markets can keep getting more expensive. And this expensive market seems to be very inclined to be getting more and more expensive, right? What about, and just to kind of reinforce that notion, Alan Greenspan, the powerful leader of the Federal Reserve throughout the 90s and the 2000s, he commented that the equity market was becoming irrationally exuberant in 1996, almost 4 years before the market actually peaked. So valuation, really good at telling you what you might be expecting over the next 5, 10, not so good for telling you when a bull market may come to a close. All right. What about inflation? Well, in our assessment, inflation doesn't by itself end a bull market, especially if inflation is viewed to be short-term, and it is viewed to be short-term by the Federal Reserve. Quite the contrary. So long as the Federal Reserve is saying that inflation is temporary, which is exactly what Fed Chairman Powell is saying right now, and as long as investors believe inflation is temporary, ironically, inflation can make a bull market get even more exuberant, because inflation is just another way of saying companies can raise prices. And when companies raise prices, their earnings go up, which gets people even more excited about buying equity. So Inflation in and of itself doesn't bring these bull markets to a close. So, bull markets, in our opinion, die from one cause, overwhelmingly in history. Bull markets die typically because the Federal Reserve kills them. The Federal Reserve has been providing accommodation, really great liquidity, printing money, keeping interest rates low, and then they decide they need to worry about inflation, not over the short run, but there's a long-term inflation pressure building, and they take the foot off the accelerator and mash on the brakes. Think about the most recent, longer-term, painful bear market that we've experienced back in 2008. People talk a lot about the housing market and all the stupid things that banks and insurance companies did and subprime mortgages and so forth. And it's all true, and it all absolutely was part of the catalyst. But before any of those stupid lending decisions were exposed, before any of that could happen, the Federal Reserve took interest rates from 1% to 5.25%. A dramatic increase in interest rates, a dramatic smashing on the brakes that then exposed all the other dumb things that have been going on in the economy. Fed policy was what led to the horrible bear market of 2008. So, what do we need to think about Fed policy now? All right, when might the Federal Reserve take their foot off the accelerator and put it on the brakes? Well, first, let's recognize that Fed Chairman Powell is saying as often and as clearly as he can that he believes that the current spike in inflation is temporary and that he's not worried about inflation. The only thing he's worried about is the 9 million jobs that were lost to the COVID pandemic. And until those jobs get replaced, he's inclined to keep his foot on the accelerator. Now, how long might that process take? Well, gosh, if we keep adding jobs at $1 million jobs a month like we did last month, hey, we might have to start worrying about the Fed taking their foot off the accelerator by the end of the year. But that does seem to give us a pretty clear green signal, at least until the end of the year. What about after those 9 million jobs are replaced? What after, the economy seems to have healed from COVID? Should we then start worrying immediately about what the Fed might do? Here's where things get a little bit more uncertain, for me at least. Because whatever the different Fed governors might be saying right now, I recognize that the US government has been dependent upon the Federal Reserve printing money and buying government bonds to finance its massive deficits since September of 2019. This is before COVID. This is before we borrowed another $5 trillion. The Trump administration needed the Federal Reserve to step in and keep the bond market from collapsing because we were borrowing $1.4 trillion in an economy that couldn't serve up that much support for US government borrowing. Now, when we get through the pandemic, when the economy's racing along, we will have borrowed another $5 trillion on top of the debt burden that we were having trouble financing back in September of 2019. Can the Fed just simply say, well, the US government's got to find its own way. We're going to take our foot off the accelerator? I don't know. I'm not sure. I do know that the last time the US government was this deeply in debt was after World War II. And after World War II, the Federal Reserve kept printing money and buying government bonds and helping the government finance this massive debt overhang for 6 years after the end of the war. And they kept printing the money and buying the bonds, even though inflation hit 10, 15% occasionally during that period of time. So inflation didn't keep them from printing the money and buying the bonds because they felt like keeping the government solvent was a higher calling for the Federal Reserve. What will they decide this time? I don't know. We do need to recognize that the Fed has learned an awful lot about the long-term consequences of inflation. I think they're much more frightened of inflation now than they might have been in the 40s. And there's an institutional bias against inflation that probably wasn't there back in the 40s or 50s. All these things suggest that the Fed won't be quite as blasé about inflation and might not be tilted so strongly towards helping the government finance its debt as it was in the past. But the bottom line is we simply don't know. The best strategy we believe right now is to recognize that the Fed right now has a clear view, a clear eye on the number of jobs being created, not the inflation pressures. That's giving us a green light for the time being. And we will keep evaluating how the Fed's stance and their assessment of their relative responsibility to help the government finance its debt and their relative responsibility to keep inflation low. As they give us more guidance, we'll give you the same. Thank you for joining us for Market Insights. We hope you found it informative. If you found it useful, we hope you will like our video and share it with your friends. Also, if you'd like to see more of our research, you can subscribe at the link below, or you can check out our website, caravelconcepts.com. Thank you.